Most investors will assume some risk on a portion of their savings in order to grow their funds by enough to meet their future spending needs. From 30,000 feet, all investors are ultimately trying to accomplish the same thing: allocate their funds across a mix of investments that have the greatest likelihood of funding their future spending needs without taking on too much risk. And although there are a lot of details around strategy and product, I believe that all investors need to first have a clear target in mind when it comes to how much of their personal wealth should be allocated between stocks and bonds. My name is Michael Carbone. I'm a CFA charter holder and a certified financial planner. And in this short video, I'll walk you through the logical framework that professionals use to help investors determine an appropriate target investment allocation. Let's get started. Your allocation between stocks and bonds should always meet the following criteria. One, the level of growth that you need to fund your future goals. Two, the level of liquidity that you need to fund your near-term goals. And three, the level of risk or volatility that you're comfortable experiencing. And if you're wondering if you should prioritize one or another, the answer is yes. Your personal risk tolerance and your needs for liquidity should almost always supersede your needs for investment returns, as a potential cost of making a poor investment decision or having to finance your future spending may well exceed the opportunity cost of investing more conservatively. The trick is to find a healthy balance. Let's start with your growth needs. So the level of growth that you need to fund your future spending needs will depend on three things: how much money you currently have saved, how much money you'll save in the future, and how much money you'll need to accumulate by the time that you need to spend it. Let's use an example to illustrate this. Say you're retired and you plan to live for another 30 years. Let's also assume that you have $2 million in savings and you're receiving some amount of income from your Social Security benefits. When it's all said and done, let's assume that you need an additional $80,000 gross to fund your lifestyle. This is what you'll take from your portfolio, and it equates to roughly 4% annual spend rate. At first, you may think that you'll need to earn a 4% investment return to sustain this level of spending, but this is unlikely to be the case because it will ultimately depend on what you're trying to accomplish. For example, if you're hoping to spend $80,000 per year without giving yourself any raises for inflation and then eventually die with $2 million, then yes, 4% is your target return. But the reality is that your goals are unlikely to be so simple. For starts, it's highly improbable that your expenditures will stay flat throughout retirement. But there's also the question of how motivated you are to leave money for your future beneficiaries. So let's do some math to illustrate this. In the scenario where you'd like to have $0 remaining in 30 years and inflation is a non-issue, you need to grow your money by at least 1.5% annually on average throughout the 30-year period. Now let's throw inflation into the mix. Say you're planning for inflation to rise by 3% on average throughout retirement. In this case, your minimum required return would increase to around 4.5%. Now let's assume that you're planning for inflation to be 3% and you'd like to leave $1 million to your kids. The required return in this case is now 5.2%. So you've got an idea about how your goals will demand a certain level of growth on your money, but how can you translate this into an appropriate mix of investments? To do this, you'll need to have some expectation for what different types of investments might offer in terms of potential growth. Say that you expect stock and bond investments to generally rise by 6.5% and 3% on average throughout the 30-year period. In the first scenario, where you only need 1.5% on your portfolio, this is less than what you would expect bonds to rise by, so no math is needed. You could, in theory, invest all your money in bonds. In the second scenario, your minimum allocation to stocks would be 43%. And in the third scenario, your minimum allocation to stocks would be 63%. These are oversimplified examples, but the point is that your investment portfolio should align with your growth needs. But let's move on. So the second criteria is the level of liquidity that you need to fund your near-term goals. As I mentioned before, your liquidity needs should be prioritized over your growth needs. So expanding on the last example, let's say that you determine a 60% allocation to stock is appropriate based on your growth needs. But your growth needs are predicated on long-term averages. And as you probably know, financial markets don't move in straight lines. So it's incredibly important to ensure that your near-term liquidity needs will be met under any market scenario. So how can you judge whether 40% in non-stock investments would be enough to insulate you from market volatility? Well, a good place to start is to gain an understanding of historical market drawdowns and the time that it took for them to recover. For example, let's take a look at broad U.S. stocks during the three deepest downturns in the post-World War II era: the oil crisis of the early 70s, the dot-com bubble at the turn of the millennium, and the financial crisis of the late 2000s. In each case, the markets generally declined for a period of 2 years on average and subsequently took an average of 35 months to recover. So in the context of a retiree who's spending off of their money and has 40% of their money in non-stock investments, if they didn't touch their stocks during these deep debt market downturns, they would have had to live off the non-stock portion of their portfolio for a period of 5 years on average. Key takeaway is that your non-stock investments should be sufficient in dollar terms to weather bad scenarios, as you're otherwise put in a position where you're potentially forced to sell stocks at depressed levels to meet your liquidity needs. So back to our same example from before. The investor has $2 million in savings and believes that a 60/40 stock to bond portfolio meets their growth needs. But does it generally meet their liquidity needs? Well, let's do some math. 40% of $2 million is $800,000. If they're spending $80,000 per year growing at 3% inflation, this amount of money would support roughly 8 to 9 years of spending, which is reasonable considering historical bad outcomes. The question of how the 40% in non-stock is invested is beyond the scope of this video because non-stock investments can certainly drop in value too. But I do generally suggest that retirees with liquidity needs deploy a good chunk of their non-stock money into guaranteed bonds like a CD or a treasury. It may be worthwhile to buy a 5-year CD ladder of guaranteed bonds to ensure that near-term needs are met. So this investor's 60/40 stock to bond proposal so far meets their growth needs without violating their liquidity needs, which leaves them with the final criteria. Does the allocation match their personal willingness to accept risk? This is a more subjective topic because human behavior is largely unique to each person. And in addition to that, most investors' behavior will evolve over time as their situation evolves. This is why it's so important to evaluate these criteria regularly. The consequences of getting this criteria wrong are twofold. You're likely to experience undue anxiety, and you're more likely to act irrationally during down markets, which may adversely affect your ability to meet your long-term goals. In my view, the most productive way to assess your willingness to accept risk is to one, reflect on past experiences. If you've been investing for even more than a few years at this point, you've likely experienced some volatility in your portfolio. How did you feel when the portfolio was down? Were you losing sleep? Did you sell your stock? Two, consider your current portfolio in dollar terms under various drawdown scenarios. There has been more than one occasion in the last 2 decades where the stock market was more than halved. Although this deep of a drawdown was relatively short-lived, those who capitulated would have made a major mistake. Three, consider the trade-offs to accepting less risk. Would you have to change your lifestyle? Are you willing to do this? Most individual and family investors need some level of growth to meet their long-term goals. It's important to understand how accepting less risk will affect what you're trying to accomplish. And four, consider the implications to your financial goals under a scenario where you were to act irrationally, making a poor investment decision during a period of market stress. What you're ultimately trying to understand is how much volatility that you feel comfortable experiencing with the goal of minimizing your anxiety and the likelihood that you'll make an irrational investment decision. If your portfolio violates either of these, you should be reconsidering your goals and consider how you might potentially adjust them to better match your personal situation. If you feel like you could use some help with this, tap the link below to see if you might benefit from scheduling a complimentary consultation with me. I'm happy to discuss how I might be able to help you put the odds of success in your favor. I wish you the best of luck, and I hope to hear from you soon.